Hello everyone, we are back with the second stream of macroeconomics. The last day we started with value added method. We will be doing a small recap on that and then we will continue with our income method and expenditure method. So I am opening a sum for you all. Okay, what were the steps of value added method? The step one was we had to find out the GVAMP of all the three sectors, that is the primary sector, the secondary sector and the tertiary sector. Then what did we have to do? We had to found out the GDPMP, and then what did we have to do? We had to find out our national income. So, and that was for, and I also mentioned that we had to do the first step GVMP of all the sectors if individually all the outputs and intermediate consumption was given. And the last day, the sum that we did, all the sectors individually it was not given, but today the sum that we would do, all the sectors have been given individually. So we can see that value of output in primary sector is what, 2000. Then intermediate consumption of primary sector is 900. So we will start doing it part by part. Okay. So we will be starting on with the value added method. Okay. Our step one was we had to found out GVAMP of all the sectors as in the primary sector. So GVMP of primary sector, the formula was value of output minus value of intermediate consumption. So what is the value of GVMP of primary sector here? Output. Value of output in primary sector is 2000 and intermediate consumption is 900. Right? So value of output minus our intermediate consumption. Right? So the values would be what? 2000 minus 900, right? So that would be our 1100. Then what do we have to do? GVAMP of secondary sector. Okay. The formula would be the same for this one as well. So value of output of secondary sector is what? 2800 and intermediate consumption of secondary sector is what? 800. Okay. So 2800 minus 800, right? We got 2000. Then GVAMP of tertiary sector. Let's have a look at the values for those. Okay. So value of output in tertiary sector is what? 1600 and intermediate consumption of tertiary sector is 600. So 1600 minus, that would give us 1000. And what did we know our next step is? That was GDPMP. What did we have to do in our GDPMP? We had to add all of our GVAMPs, like of primary, secondary, as well as of the tertiary sector. Right? So 1100 plus 200 plus 1000. That would give us 2300, right? Then what has been said, like these two steps we have to do. Now we have to see what is given in the sum. So what it has been said, calculate NI, as in we have to find out our NNPFC and GDPFC. Now in the sum we have our GDPMP. From this like just the simple thing that we have to do is what, from market price we have to go to factor cost, and that would give us our GDPFC. So first we can do what, we can find yes, GDPFC, right? For GDPFC, what do we have to do? The formula GDPMP minus your NIT, or if NIT is not given, minus IT plus your subsidy, right? So GDPMP would be 2300. Let's have a look at the other values. What have we been given? Okay, we have been given our NIT directly. So minus 300, right? So this gives us 2000. So we have the value of GDPFC now. Now we have to find out NNPFC. NNPFC is what? What is the formula? Look, we have GDPFC, and now if we convert GDPMP to NNPFC, we have to change this MP to FC factor as well. But यहाँ पे GDPFC में we have already like deducted the FC factor. So if we go from GDPFC to NNPFC, we will just have to change the factors of gross to net and domestic to national. So GDPFC gross से net जाने के लिए we have to do what, deduct our depreciation, and from domestic to national we have to plus our NFI, right? So what is the value of GDPFC? That is our 2000, and we have been given our depreciation, that is 470, and NFI is minus 30. It was 470, right? Yeah, 470 minus 470 and minus 30. Now give me the value of NNPFC. Even you can say 1500. 1500. Even in the comment section, the students can answer what is the value. So it's 1500, right? So that is how we have to found out our NNPFC and GDPFC through value added method. Now we will go on to our income method. So value added method is clear to everyone, I hope so. Now we will be jumping on to income method. Just like value added method we had certain steps, for income method also we do have certain steps. What is the first step? Step 1 for income method would be to get our NDPFC. Now for NDPFC, we have to understand certain things. That is, first is what? Compensation of employees. The formula for NDPFC is simply compensation of employees plus operating surplus and plus your mixed income. Okay. The second step would be to get your NNPFC, right? Now if we have the value of NDPFC and we have to go to our NNPFC, if we know what are the factors that needs to change. Now see, this is net and this is net as well. Only the factor that is changing here is from domestic to national, right? So NFI plus. In income method, we just have these two simple steps, but we have to understand what comes under compensation of employees and operating surplus. Now look, mixed income, the value of mixed income that is given to you as a whole. Like there are no subdivisions of mixed income. You will be given the value of mixed income, suppose 1000, 10,000, whatever it is, as a whole, and you like do not have to plus or add or deduct anything for mixed income. But for compensation of employees and operating surplus, you might be given the values as a whole, or you might be given the sub parts of it, which you have to add up and get to your compensation of employees. Now, compensation of employees, as in anything that you're receiving from the employer or from the company that you're working in, right? Just say when you're working for the company, you will be receiving wages, right? You will be receiving salaries. Like these are the most common things that are given to you. And what can be it? House rent allowance, or it can be any contribution that is done by the employer for your welfare scheme. So it might be given employer's contribution towards social welfare. Now see, to confuse a few people, it might be given employers contribution towards social welfare schemes, or it might be given employees contribution towards social welfare schemes. Now by compensation of employees, we mean anything that the employee is getting from the employer, not anything which the employee is contributing for himself or herself. So if we are given employers contribution towards social welfare, we will be taking that into account. But if we are given in the table employees contribution, that would be a big no. You won't be taking that. So if employees contribution is given, you won't be taking that into account. Anything given by the employer or by the company to you, to the employee, only that will be taken into account. So these are the most common things that comes under your compensation of employees. When you'll be doing the sums, you will understand, like while doing the sum, it is better for you to understand that what are the things that you're supposed to take. Like I might make a list here, but you might not understand as long as you don't do the sums on your own, right? Now comes this is your compensation of employees. Another thing was what? Operating surplus, right? So operating surplus, what are the things that comes under operating surplus? Rent. Rent as in you have a land and you have rented out to someone, so you are receiving the rent, and that rent is a form of income for you. So anything that is a form of income for you, that comes under operating surplus, right? So rent. Profit, you have invested in a particular business and you have earned profits out of it. So anything that is an income for you, that comes under your operating surplus. Rent, profit, dividend, then undistributed profits, royalty. I'm writing the most common things that are given to you, okay? So compensation of employees and operating surplus, I hope the things that are common are clear to you. Now the one thing that does confuses people is what? When you're given the sum in your examination, you're given it in a tabular format. Now in your table, suppose you have, and as I said, mixed income is given to you as a whole, no subdivisions are given. Now for compensation of employees, suppose in the exam you are given CO is 1000, and then you are given, suppose, house rent allowance 200, dearness allowance 100, and other things. That mainly I want to say that there might be compensation of employees given to you as a whole, and there are other things that comes under your compensation of employees that is also given. So what do you have to do in that case? You have to take the whole value of compensation of employees and not the subparts. I hope that's clear to everyone. And same would be for operating surplus. You are given a particular value for operating surplus, and you are given the values of, suppose, rent, interest, and all these. So what do you have to do? You have to take the value of operating surplus and not the subdivisions. And if these two are not given, only the subdivisions are given, then you have to add it up all and get your NDPFC. I hope that's clear to everyone. And mixed income, the value is given total as a whole. So from, if we know what our compensation of employees is, what our operating surplus is, and the value of mixed income, we can get our NDPFC. Now, after we have got to our NDPFC, we can get our NNPFC from there if we know the like what are the factors that are changing and what exactly do we have to do, like from going from gross to net, from national to domestic or domestic to national, and MP to FC. Okay, so we will do a sum on this and then we will go on to our expenditure method. Okay. Number 6, calculate NI and NDPFC from the following data. Now see, in the table it is nowhere written that what method do you have to use, right? So you have to know that under income method what are the things you might be given, and under expenditure, we haven't gone to expenditure method yet, but still, what are the things that are given under value added method, expenditure method. If only you know the things that comes under those, you will be able to identify, even if it is not written, that you have to find, get to the answer by income method or value added method or expenditure method. Because see, in this question it is not given through which method, but if we look at the table, wages and salaries, it comes under what? It comes under your compensation of employees. Then rent comes under your operating surplus. Interest comes under your operating surplus. Dividend also comes under your operating surplus. Undistributed profit comes under your operating surplus. We will take corporation tax, yes or no? No, we won't be taking corporation tax. Then comes your mixed income. Like I said, mixed income will be given to you as a whole. So mixed income is given to you. Now, there might be, just like corporation tax, there might be some values that are given to you just for eyewash. So you have to understand what are the things that are you going to take into account. Take it. Then comes your NFI and depreciation. So we will look into that later. Okay. So what is the value of wages and salaries? It's 120. Then rent. Okay. Let's get to the sum and have a look at it one by one. NDPFC. NDPFC is equal to what? Compensation of employees. I am writing it in short. Operating surplus plus mixed income. Okay. Rent is 120. Sorry, wages and salaries is 120. Rent is 60. Interest is 25. So we will be taking the first 5 values from here first. 120, 60, 25, 15, 50. 120, 60. Okay, I forgot. 25, 15, and 50. Add up and let me know the total. Okay, sorry, I missed out one thing. We have to take into account our mixed income as well. Mixed income is here at G, so 10. Okay, so plus 10. What's the total? 280. So the total would be 280, right? Then what do we have to do? We have to get to our NNPFC. For NNPFC, we have our value for NDPFC, and we have to do what? We have to add our NFI, right? So NDPFC's value is 280. Let's have a look at what is our NFI's value. 10. Okay, NFI is 10. So our NNPFC is what? 290, right? So in the question, it is only said to get to our NNPFC or NDP. Yeah. So we have got our values for NI, NNPFC and NDPFC both, right? So I hope this sum is clear to you people. Then income method is clear. What are the two steps for income method? I'm just giving a short recap. We have to get to our NDPFC first. The step one would be to get to our NDPFC. For that, we have to take into account our compensation of employees, operating surplus, and mixed income. What are the things that comes under compensation of employees? As in anything that we are receiving from the employer or from the company we are working in, as in wages, salaries, house rent allowance, employer's contribution, and anything that the employee is contributing and it is given in the table that you're given in your exam. Anything contributed by the employee, you won't be taking that into account. Clear? And operating surplus, as in any income that we are getting, just as rent, profit, dividend, undistributed profits, royalties, these things. And mixed income, like it will be given to you, the all the values might be given to you as a whole, or it might not be, like the compensation of employees and operating surplus. But mixed income, that value is given to you, no subdivisions are given. That is our step one. Then step two is what? We have to calculate our NNPFC. Like in each and every sum, we have to calculate our national income if we are set to do so. So NNPFC is equal to what? NDPFC plus our NFI. Okay. Now we will be going to our expenditure method. So the first step for expenditure method would be to get our GDP-MP. What is the formula for GDP-MP? The formula for GDP-MP would be private final consumption expenditure, right? Then would be our gross domestic capital formation. Then government final consumption expenditure plus your net exports. This would be export minus import. Now see, if you're given net exports directly, well and good, but if you're not given net export directly, you will be given your export and your import and you have to deduct that, right? Now, all the other values, as in private final consumption expenditure, government final consumption expenditure, these two are given to you as a whole. Taken, it might be so that your gross domestic capital formation is not given to you in the table. If gross domestic capital formation is not given, then what are the things you might be given? Net domestic capital formation, right? You have to look for your values of net domestic capital formation and depreciation and change in stock. This is how you will get to your gross domestic capital formation. This is gross domestic capital formation. So you will be getting your gross domestic capital formation by adding net domestic capital formation plus depreciation plus change in stock. Now in the table, if change in stock, maximum time the change in stock is not given, so you will take that to be 0. And your depreciation, if your depreciation is not given, that also you will take that to be 0. Another confusion that might occur is what? If you're given gross domestic capital formations value as well and net domestic capital formation value as well. In that case, you will be taking your into account your gross domestic capital formation, because that is what is there in the formula. Your formula for GDP is private final consumption expenditure plus gross domestic capital formation plus government plus net exports. In If and only gross domestic capital formation is not given to you in the table, only then you will look for these values: net domestic capital formation, depreciation, and change in stock. Maximum times the change in stock value is not given. If depreciation if depreciation is given, well and good, and if depreciation is not given, then only net domestic capital formation you will take into account only then when gross domestic capital formation is not given. If gross domestic is given, you will be taking that one. Is it clear? Okay. Just if to move, like, to remove your confusion, suppose this value is not given, gross domestic capital formation, and no net domestic capital's formation value is 1000, and you are not given your depreciation as well, and you are not given your change in stock as well. In that case, the value would be 1000 for gross domestic. And then if depreciation and change in stock is given, then the value would be something else. Is it clear? You have to look for this value first, and if this is not given, then these three values. And whatever value is not given, you will be taking that to be 0. I hope it's clear to everyone. Okay. Now we will start by doing a sum. Now see, in this you have been told to get your income, like you have to use your income method and expenditure method both, right? So first do your income method, then we will go to our expenditure method. We will be doing both the methods in this one. So for the income method, you have to, I'm just telling you what are the things you have to take, and you will do the sum and write in the comment box what is the answer. So income method ke liye what are the things that you will take? See, compensation of employees is given to you, and we can see in the table nothing related to compensation of employees is given, right? So compensation of employees is 800, the first step to find out, to get to our NDPFC. Then comes profits and rents. So 500 plus 200 here. Then we will skip to our interest 150. Then mixed income of self-employed 630. So these are the things that you have to take into account. Do that and tell me the value. Compensation of employees is 800. Profits, just the NDPFC value. 800, 780. Compensation of employees is 800 itself. 780. Then comes your profits, that is 500. Then your rent 200. Then interest is 150. Then mixed income of self-employed is 630. 2280. So your answer for NDPFC, just for your NDPFC by income method, would be 2280. Then for calculating your NNPFC, what do you have to do? You have to plus your NFIA. What is the value of NFIA here? 20, right? Net factor income from abroad is 20. So your final answer for NNPFC through income method would be 2300, right? Clear? I'm not doing the income method with you because you people even need to try out sums on your own. Okay. Yes, Shoham, NDPFC is 2280 and your NNPFC is 2300. Then we will be skipping on to our expenditure method. For expenditure method, what is the first formula? GDPMP is equal to what? Private final consumption expenditure. So we have our private final consumption expenditure here to be 1200. Then what do we have? Government final consumption expenditure, we can see it's 800. Then we have been given our net exports minus 30. But do we have our gross domestic capital formation? No. So if we don't have our gross domestic capital formation, what do we have to look for? Net domestic capital formation is given 500. Consumption of fixed capital, that is our depreciation itself, that is 150. Is change in stock given? No. Right? Okay. Let's write down the formula once first. So for the sum, for the expenditure method part, what is our formula? GDPMP is equal to private final consumption expenditure plus gross domestic capital formation then government final consumption, then net exports. So in our sum we have the value of private final consumption expenditure is 1200, then 800 is our government and minus 30. So 1200, 800 minus 30. 1200. I'm just keeping some space for the gross one. Minus 30. Okay. So for gross domestic capital formation, we don't have the value together. So net domestic capital formation is 500 plus 150. So the total value of gross domestic would be 650. Right? Okay. Give me the total value.
2620.
2620. Okay. So the value for GDP MP would be 2620. Now for this also we have to get to our NNPFC, right? So GDP MP minus depreciation plus NFIA minus NIT. Okay. So GDP MP's value is 2620, then minus 6. Let's go to the table back. Okay. Minus 150 is given, then plus your NFIA plus 20.
NIT is minus 190.
150 plus 20. NIT is
Minus
190. Okay. So give me the value of NNPFC.
2300.
2300. Okay. So the value of NNPFC would be 2300. Okay. So this is what we have had to do in our income and expenditure method both. Okay. So for the income method, what was our value for NNPFC?
Compensation of employees, operating surplus.
What was the value, like the sum that we did, we had to get to our NDPF, and we had to find out through income method and expenditure method both. So what was our value for NNPFC through income method?
2300.
Okay, so that is how you will like know that your answer is correct if you're given to like get to the sum through both the methods. The national income's value would be the same for income as well as expenditure method, no matter what method you are using. Okay, if you're given like in your exam you probably will be given to use just one method, but still you should be knowing all the methods here. We will be doing one or two more sums. Okay. Now do this first sum. Calculate depreciation and national income from the following data. Now see here, even if you look at the table, you will see that you do not have to use any method. You just need to know the formulas, the initial formulas that you were given. Now calculate depreciation. What did we know the formula for depreciation? Anything gross that is given and minus your net. So what you're given here, gross domestic private investment, net domestic private investment. So your depreciation would be equal to what? 300 minus 200, that gives you 100. Right? So you have your value for depreciation now. Okay. Number 1, depreciation is equal to gross minus net. So 300 minus 200, that gives you 100. Now look at the sum. See, we have been given GNP at market price and we have to calculate what our national income. So first, let's see what are the changes that we have to do. GNP MP we have been given and we have to take it to what? NNPFC. Sorry. NNPFC we have to GNP MP. So from gross to net minus depreciation, both are given in national, and then what is given? MP to FC minus NIT, and if NIT is not given, minus IT plus subsidy, right? Let's have a look at the values. GNP MP is what? 1500. Subsidy, see, now see यहाँ पे we don't have our like we have already found out our depreciation value, so we have to take that. So 1500 minus your depreciation value was 100, that gives you 1400, minus 150 plus 100. Okay.
1,350.
What was the value of GNPMP?
1,500.
Okay. 1500 minus 100, IT 150,
Yes, ma'am.
subsidy
100.
was 100. Total value,
1,350.
so the total value would be 1350. So here we did not use any method, but what did we do? We just knew our initial formulas, and this is a sum from the year's paper. So what do you have to do? You have to know the initial formulas that I gave, from gross to net, from net to gross, all those formulas by heart. You have to know those very well. Okay. I hope this sum is clear to everyone. Then number 2. From the following, calculate GNP at factor cost. And what do we have been given? GDP at MP, right? So if we are given GDP MP and we have to take it to our GNP FC, we can do that. GNP FC, and what have we been given? GDP MP, right? So both are given in gross, but this one is given in domestic and you have to take it to national. So NFIA, and from MP to FC minus NIT. The same way you have to do all the sums. You just need a bit of practice. Okay. So GDP MP is 5000. Sorry. Plus your NFI is minus 100. There's a minus sign there. Plus minus 100. And what's your NIT's value? NIT is given directly. No, NIT is not given directly. So minus 150 plus 50, that gives you 100 minus 100. So that gives you 4800. These are the simple sums, like these are the sums from the last 3 years paper, these last few sums, just this one and the one before that we did. So you can understand that the sums that are given to you are quite easy if you know the formulas properly. If you know the formulas, the 6 marks is nowhere gone. Okay, then we will be doing the next sum. From the following data, calculate GDP at market price. यहाँ पे what have we been given? We have been given NI, as in NNPFC we have been given, and okay, we have to get to our GDP MP, right? So let's write down the formulas first, and in your exam, positively write down the formulas when you're doing the sum. Do not apply any shortcut. Okay. So from net to gross. Now see, we are doing just the opposite. We are not going from gross to net, we are going from net to gross. So it will be plus depreciation.
minus NFIA
Then we are going from national to domestic, so minus NFIA.
plus NIT
Then we are going from FC to MP, so plus NIT or plus IT minus your subsidy. Clear? So what is the value of NNPFC? Now let's write down the values one by one. NNPFC is 58,000. Okay. 58,000. Then let's see if we have the value of depreciation. Consumption of fixed capital is given 1200. So plus 1200. Then is NFIA given directly or not? Let's see that. NFIA is not given directly. We have been given factor income paid to abroad and factor income received from abroad. So received from abroad is our export and paid to abroad is our import, right? So export minus import, that would be 9,000 minus 12,000.
minus 3000
So that would give us minus 3,000. I'm writing the value as a whole. Then, okay, minus 1,000 and subsidy is 6,000. So IT is 1,000, subsidy is 6,000.
3%.
Plus 1,000 minus 6,000. So that would give us minus 5,000. What's the answer?
51,200.
The answer to this would be 51,200. If you know the formulas properly, if you do the calculation properly, you will be able to solve the whole sum. So this is what you had to do. So you can see that you have not been given like through any method, but you have been given just simple sums based on the formulas that you already know. So this is what you had to do. So we have covered all the three methods of national income: the value added method, the income method, and the expenditure method. Now see, the private income, personal income sums, those sums are not given to you, so I'm not doing that with you as of now. I'm just covering the important portions, right? So after we have done circular flow, yeah, the last day itself, and the sums are already done. Now what are some of the few things you need to know from this chapter which are important? That is your GDP deflator, right? In the question it might be also be given what is implicit deflator, right? So the answer would be the same for both. What is GDP deflator or implicit deflator? It basically calculates the impact. If inflation is going on in the economy, it basically calculates the impact of inflation on the GDP of an economy, right? And you definitely have to write the formula for this one. Nominal, nominal GDP by real GDP into 100. Okay, in your internals, like in some of your internals, this sums were also given from this one. So no tough, even if you're given sums from this one, it wouldn't be tough. You will be given your nominal GDP value itself. You will be given real GDP's value, and what you have to do, you have to use the formula nominal GDP by real GDP into 100. That is simply what you have to do, right? So this is what GDP deflator is. GDP deflator is what? It calculates the impact of inflation on the GDP of an economy. That's the simple definition. It might be a sub part of the question that you might be given. So 2-3 marks, and you have to write down the formula for that as well. Formula is a must. You have to remember the formula. अब ये real by nominal मत कर देना. The answer would be whole wrong. Okay, so nominal by real into 100. It's not real by nominal into 100. Okay. The next question is what? Now see, national income, it in an advanced economy or in an economy like us, it's fine, but in a less developed economy, what are the problems that they might face? ठीक है? Problems of calculating national income in a less developed economy. The first foremost important problem is, that is what? Possibility of double counting. ठीक है? Possibility of, now what is the error of double counting? That's a very important concept. Like that question might also be given, that what is the error of double counting, or double counting is also known as multiple counting. Double counting and multiple counting both are the same things, right? Now see, what is double counting? When does that error occur? Now, if the value of final goods is 1000 rupees, in the value of final goods, like whatever is the value, I'm assuming it to be 1000, the value of whatever cost has been incurred of intermediate goods or whatever it is, all has been calculated in this value of final goods. So now if you take the value of final goods as well and you take the value of intermediate goods, suppose it's 200. So if you take both of these values when you're doing your calculation, it would go wrong. That is where the error occurs, that you're taking the value of your final goods as well as your intermediate goods or whatever the cost that has been incurred in the factors of production. If you take all the values together, your calculation would go wrong. So that is basically the possibility of double counting, as in you are taking the value of final goods as well as your intermediate goods itself. How to, like, there might be a question that write down the steps that you can take to avoid this error. What are the steps that can be taken? Like individually, in each and every part, what you can do, you can take down the values. Like if you have incurred a cost of rupees 100, then you have incurred a cost of rupees 200. Like each and every step you are writing down the values, right? That can be one thing. Or what you can do, you have to make sure that you are taking the value of final goods and not the value of intermediate goods. So those are the two steps in which you can, these are the two steps in which you can be sure that this error has not occurred. So first of all, I was discussing that the problems of calculating NI, but I went into altogether a different topic because double counting was here. So I hope double counting is clear to you. Error of double counting or error of multiple counting, when does it happen? When you are calculating the value of final goods as well as the cost of factors of production, everything together, right? If you're taking all the values together, that is where the error occurs, because in the value of final goods, already each and every value has been taken into account, right? And what are the steps that you can take to avoid that? Either you can do what? You can calculate the values, you can note down the values at each and every step, or what you can do, you can make sure that you are taking the value of final goods only and not of the intermediate goods or whatever cost has been incurred in the production process. So those are the two steps that you can take into account. So the question was what? Error of double counting. Sorry, the spelling is wrong. So the question was, this is a separate question. Error of double counting or multiple counting. Okay. And the steps to avoid it. ठीक है? This is not Marvel DC. This is double counting, error of double counting and multiple counting. ठीक है? Okay. So this is one question. This is another question, that what are the problems of calculating national income in a less developed economy? So first problem is what? Possibility of double counting. We already know what is the meaning of double counting now. Now In a less developed economy, we can assume that the people there, they might not be so well literate, so they might have the problem in doing the calculations. They might do what? They might take the value of intermediate and final goods altogether. So that is a problem in a less developed economy where people are not literate. Okay, it is basically an assumption that those people are not literate. Okay, then the next point would be what? I'm just cutting out these parts. Output may not be sold. Now see, when we are calculating national income, we are doing what? We are taking the values of a particular year. Like this year's national income, when we are calculating national income of this particular year, we will be taking down the values of this year itself. Now, last year, if there have been some production and the things have not been sold, right? Then what? It is not calculated in this year's national income. So that is an issue itself. Or what can be it? Like the farmers, they do what? They do their production and they do what? They consume some of their whatever crops, rice and anything they are producing. They are consuming those as well, but they are not paying for it. Like it's their own crop, so why will they pay for it, right? So that is also a difficulty in national income, because production hua hai but the value is not taken into account, right? Clear? Then comes sale of antiques. Now see, if antique means what? A year old, not a year old, like many years old thing which is an antique now, or a painting, suppose. What is happening? That painting which you have bought like many years, or which you have got from someone many years before, you are selling it now. So that will not be taken into account. Why? Because it is an antique, it is not produced, it has not been made in this year itself. So we are getting that income, but we are not calculating it in our national income part. Clear? Then comes your data problems. Now data problems, what is happening? Like in a less developed economy, we can't expect that they are doing all their calculations properly. They have a laptop or a computer to save everything, to save each and everything. So there might be a problem in data, like they have not been able to save, and like they have everything in their mind, and it might be so that they have forgotten what the calculations are. So data problems can arise because they do not have well equipped instruments to store the data with them. Clear? Okay. So these are the few important questions that might come from national income. Okay. So I will go to the third chapter today, a bit of it, not much. Okay. So the name of the third chapter, I hope it's clear, like whatever has been done till now, it's clear to everyone. Okay. Now see, the name of the third chapter is Theory of Equilibrium Income Determination. Now, from the name we can understand that we have to determine the equilibrium level of income. ठीक है? Like many students, they have problem in understanding the graphs, like what do they have to do exactly in the graphs, right? But basically this chapter is actually very easy. You just need to understand the concepts and you can do the drawings from your own. Like you can, not the drawings, you can basically do the graphs from your own, right? But we need to understand a few things before jumping on to the graphs. Like hopefully I will do the graphs in the next session and I will just explain some topics today on this chapter. The first one is what? Aggregate demand, right? What do we understand by aggregate demand? Aggregate demand as in whatever demand has been taken place, like whatever we, the consumers, are demanding. Obviously the investment, the business sectors, they are also demanding for goods. The government sectors, they are also demanding for goods, and the rest of the world, they are also doing the same. So whatever demand has been going on in the economy, that is your aggregate demand. Now definitions are not asked, but you need to know the formula. What is aggregate demand ka formula? What did I say? That what we consumers are demanding. So C, what the investment sectors or the business sectors are demanding, that is your I. What the government sector is demanding, that is your G, and X minus M, that is your rest of the world. Now see, this portion, right, is basically your closed economy. This section basically comes under your closed economy, and you will be talking about this sector only when it is asked for an open economy. But in this chapter, there won't be a single question from the open economy part, so this portion is not valid for you. What you have to do, you have to concentrate on this part, or mainly in this chapter, mainly what they do, when you're asked to determine the equilibrium level of income, like when I will be doing the graphs, you will understand what I'm talking about. When we are asked to do the diagrams, we basically will be taking into account just the C plus I part, not the G. In the question, if it is specifically mentioned that we have to talk about our G or the government, then we will be taking into account our government. But we are assuming whatever income that has been, like whatever income has been incurred, that has been divided into two parts, that is C plus I, consumption and investment, right? So for each and every diagram, we will be determining an equilibrium condition, that is y is equal to C plus I, where our point, like what do we know our equilibrium is, where two points are meeting, that is our equilibrium point, like the break even point. So when it is y is equal to C plus I, so when y line is intersecting with the C plus I line, this is the point where we will be getting our equilibrium condition. Let's not jump into that as of now. I hope it's clear till this part, right? Then is our, I'm just discussing the important things from here. MPC. What is the full form of MPC? It's marginal propensity to consume. Now marginal propensity to consume, as in, like marginal in economics, by marginal we mean an additional unit, right? So suppose your income this year or the last year was rupees 10,000 and it increased to 15,000 this year, right? So when your income was 10,000, you were consuming, your consumption value was 5,000, and when your income increased to 15,000, your consumption value became 10,000. ठीक है. So what is the difference? Your formula for MPC is delta C by delta Y, as in depending on how much your income has changed, depending on that how much consumption you're willing to change, right? So your income was 10,000 and it shifted to 15,000. So what is your value for income? Delta Y is 5,000, because that is the change in your income. And now what is happening here? 5,000, you were consuming of 5,000, and now now you have increased your consumption by 5,000 more, so 10,000. So 5,000 by 5,000, you are getting your MPC to be 1. Like whatever extra you are earning, you are using it wholly on your consumption basically. Clear? Is this clear? So MPC is what you are asked for, the explanations of MPC. So what is MPC? How much, like your whatever additional income you're earning, depending on that how much you're willing to make a change in your consumption, you're willing to increase your consumption, that is your MPC, right? Then comes your APC. APC is what? Average propensity to consume. Okay, basically what you're doing C by Y, as in whatever your income is, you're finding out how much you're consuming, like you're finding out the average of it. Clear? Definitions आता है MPC का mainly. This definition is not so important, but still just have a look at the formula. Just keep the formula in mind, that APC is what? C by Y, because you might be needing it for the sums. Mainly even for the sums of this chapter, you will be needing the MPC's formula. ठीक है. So APC is what? C by Y. What you are doing? You are basically finding out the average depending on how much you are, like on your income, how much you are consuming. You are finding out the average of it. Clear? Okay. Now see, there is another thing called consumption function, because when we are doing the diagrams, we will be needing our consumption function as well. What is our consumption function? Consumption function is basically C is equal to F of Y. Now C is equal to F of Y, as in C, Y we know it's our income, right? Income is not denoted by I, investment is denoted by I, income is denoted by Y. ठीक है. So consumption function is basically what? Consumption is depending on our income. See, now if our income increases, we will increase our consumption as well, and if our income decreases, we will decrease our consumption, right? So that is what consumption function is. Now under not exactly under consumption function, but under consumption there is another important part, that is what? Autonomous consumption. Now what is autonomous consumption? Autonomous consumption, you are now not asked for the definition, but you have to know what is autonomous consumption because of your diagram. Now what is autonomous consumption? Autonomous consumption is that part of the consumption which you are consuming when your income level is 0. Now you being a student, obviously you are going back home, your mom is cooking something for you. Are you paying for that? Obviously no. So that is part of your autonomous consumption, as your income level is 0, but still you are consuming something, right? So autonomous consumption is what? Autonomous consumption is that part of the income which is that part of the consumption which you are doing even when your income level is 0. Now that example that I gave, that you're going back home, you're having food, that is not from economics point of view. From economics point of view, what is happening? Autonomous, when we are not earning anything, we are still doing consumption, that is our autonomous consumption, but obviously we have to pay for the goods. From where are we paying that amount? It is assumed that we have previous savings with us. We have previous savings which we are breaking, and we are using that money to consume. That is why our savings curve always starts from the negative axis. Why? Because it is assumed that initially you are breaking your previous savings to consume food, or to carry out your basic necessities. So that is why your savings curve always starts from the negative axis, and your consumption curve. So just keep in mind, your savings curve always starts from the negative axis, because we will be needing this when we are doing the diagrams. And your autonomous consumption, now see, even when your income level is 0, your consumption can never be 0, right? So your consumption curve never starts from the origin. Just keep that in mind, your consumption curve never starts from the origin. Your consumption curve starts way above the origin. It will never touch the origin when we will be doing the diagram. So your consumption curve never touches the origin. Clear till now? Okay. So autonomous consumption and savings, like the consumption part we will be needing in each and every graphs. Savings part we will be needing only in those graphs in which we are asked for the savings. Okay. Then the next, okay, so we will take this to be number 6, the savings concept. Now what is it? Investment. Okay. So investment is of two types. One is autonomous investment, the other one is induced investment. ठीक है. Now what is autonomous investment? Autonomous investment is that part of the investment, not that part, autonomous investment is that investment which remains fixed irrespective of the levels of income. Now see, before starting with the investment, we will do another thing. I am writing that as 7.1. Investment function. Just as we did consumption function, there is something called investment function as well. In consumption function, what did we do? That your consumption is depending on your income. When your income increases, your consumption also increases, and when your income decreases, your consumption also decreases. Same for investment function. Your investment is also dependent on your income, because see, investment as in the business sectors are investing in their business, and if they do not have income, or similarly when their income is increasing, their investment will also increase, and when their investment is decreasing, when their income is decreasing, their investment will also decrease. Same as consumption function. Consumption is for the households and investment is for the business sectors. So when the business sectors are earning more, they are increasing their investment. When their income is not so much, when their income is decreasing, their investment is also decreasing. Now investment, there are two parts of investment, one is autonomous, one is induced. Now autonomous investment is what? Autonomous investment is fixed irrespective of the levels of income. Even if your income is increasing, decreasing, whatever it is, your autonomous investment, that will remain fixed, right? So your diagram for autonomous investment would be like this. This is a straight line. It has become a bit curvish, but it is a straight line. Okay, so this is your I naught and this is your level of income. So autonomous investment is what? Autonomous investment will remain fixed at any level of income. Clear? This is autonomous investment. What is induced investment? Exactly the opposite. Induced investment as in when your levels of income will increase, your investment will also increase, and when your income will decrease, your investment will also decrease. Clear? I am doing the diagram for that as well. Okay. So this is your investment line. Sorry. Okay. Okay, just avoid this portion. Sorry. This is your induced investment. Now see, it is also not starting from the origin, because when you're starting a business, you're obviously investing into it. So your investment can also not be zero, right? But your autonomous investment was what? It was a straight line, but your induced investment is what? It is going on increasing, but it will not touch the origin. Your induced investment is not a straight line, it is a bit curvish line, it is going upward, it is an upward sloping curve. Clear? So this is what your autonomous and induced investment is. Now for each and every diagram, you will have to know certain things, that is what which I have explained. First is what? Your income line. Okay, I'm just giving a small gist of the diagram. Now see, suppose you have been said that you have to determine your equilibrium level of income. Okay, in a closed economy, and when it is in a closed economy, you are taking, as I said, you won't be taking into account your government as long as it is not asked in the question. Okay, so what do we know? Our equilibrium condition, we already know it is C, y is equal to C plus I, right? Y is your income and it is divided into two parts, that is C plus I. Okay, so what are we doing here? The basic things that we have to plot on our diagram is what? We will be needing our I. I am considering it to be an autonomous investment. This is your I. Your I diagram will be here. Then your consumption, right? Now, these two things you have to draw it together as well. So this is your C plus I line. So your C plus I line is this one, and you have to do what? You have to draw your Y now. Okay? So Y is what? Y is always a 45-degree curve because it is assumed that your income is equal to your expenditure, which is not always the case. Okay? Like in reality, your income is not equal to your expenditure. You might do your savings or something, but it is assumed that your income is equal to your expenditure. So, sorry, income line would be a 45-degree curve, and you have to mention 45-degree here. Clear? This is Y. This is your Y line. Now, what is our equilibrium condition? Our equilibrium condition is equal to Y, our equilibrium condition is Y is equal to C plus I. So, this is our Y line, this is our C plus I line. Do not confuse it with the C line. You have to take into account C plus I. So, where is it meeting? Here, right? So, you can say, you will drop a line down and say, this is your income line. We already know that this is our income line. We can say that this is our equilibrium level of income, and at point E, what is happening? Our equilibrium condition is satisfied, that is Y is equal to C plus I. I am not showing any other thing today. You just need a bit time, like those who do not have much idea about this, just you need some time to digest this. So we will just be doing till here. So I'm just giving a small recap on this diagram. What do you have to do when you are asked to determine just the equilibrium level of income? The question is, I am just saying to determine the equilibrium level of income, and I am saying this, but you have to do more for the diagram, which I will explain in the next session. But what diagram you have to draw? You have to do what? You have to draw your x-axis, y-axis. On your x-axis would be your income line. On your y-axis, you will write whatever you have drawn touching this line. So, what are the things you have drawn? Investment, C, C plus I, right? So, you have written it here. Now, your investment line, I have assumed that this is your autonomous investment. In your question, it will be given, you have to draw autonomous or induced. Whatever is given, you have to do accordingly. But if nothing is written, you can draw any one of the two. You can draw either autonomous or induced. Okay? So I have assumed it to be an autonomous investment, so I have drawn that line. And we already know that our consumption curve never starts from the origin. So like above the investment, we are drawing our consumption line. Our consumption line and our investment line will not touch each other. There will be a small gap. Now, above that, above our C line, our consumption line, we will be drawing our C plus I. That is our consumption plus investment line all together. Okay? Then what we will do? We will draw our income line, which is a 45-degree line. You have to mention the 45-degree here. That is your income line. Then what you will do? Where Y is equal to C plus I, where those 2 points are cutting each other, you will mark that point and drop the line down and consider that and write that to be your equilibrium level of income. And what would be your basic definition? Like when you're doing the diagram, you have to explain your diagram as well. So you have to write where you have drawn like your income axis and everything you will write. And then what would be your first line? That at point E, both of our equilibrium conditions, that is Y is equal to C plus I, is meeting, where our equilibrium level of income is YE. Now, this is just the basic thing, but when you're asked for in the question, in your examination, you have to show if your first would be this one. You have to do this portion definitely. Then you have to do what? I'm just doing the diagram and not explaining that part today. You have to do what? You have to write Y1 and Y2 and draw these lines upward. Now, the thing is, if your income is Y1, then what do you have to do to push it towards YE? And if your income is Y2, what do you have to do to push it backwards YE? So these are the two things you also have to explain, but we will do this in the next session. I won't be overloading you with it. So whatever we have done till now, just go through it, just revise it, the diagram, because the mainly the diagram comes from this, and some relationships of MPC, MPS and all those things come. Sums are sorry, sums, it's not so important, but the sums are really very easy, so I will be doing the sums with you as well. So that is all for today. I will meet you in the next session.